I get so many questions in regards to tax and the impact that tax has on investments, and people say that there is no investment that doesn't involve tax. And you almost 100% right when you say that. The only investment that's tax-free, completely tax-free, is tax-free investments, tax-free savings. Whether you are making use of a bank product and you are earning interest, or whether you're making use of a tax-free investment through an investment house, and you're making use of a portfolio or unit trust, those plans are completely tax-free. Yes, you're taking your money that you have earned as a salary and have already paid tax on, and it's in your bank account, and you invest in that. But when you invest that, every cent that you invest is tax-free, as well as all the growth that you get on that. That is why it is limited to 36,000 Rand per year and 500,000 Rand over your lifetime. On all the other products, there's a tax implication. Retirement annuities works like tax-free plans in that you contribute towards a retirement annuity, you actually get a tax rebate on those contributions. The growth that you earn on that investment is tax-free. So now you've got a tax rebate in terms of the premiums that you contributed, and the growth is tax-free. When you get to retirement, a portion of the money is tax-free, but then the income is taxable. And the income is obviously only taxable if the income is big enough to put you into a tax bracket. So that's the second best option when it comes to investing and trying to be as tax-free as possible. Then the third one would be an endowment or a life investment. A life investment or endowment is taxed within the fund. This means whatever you invest, the portfolio manager that is managing your money, he's taking care of all the capital gains tax that happens within that fund. And that is done at 30%. So that portfolio manager is taking care of it. You're putting in your investment, and then when you take the money out, whenever it is in the future, whenever you decide to take the money out in the future, it's already been taxed. So in your hands, it's after tax money, and always referred to, or very often referred to, as tax-free. But now there's no more tax on it. So whether you take an income or you take the lump sum, there's no more tax implication. So that's good if your tax rate that you have, your personal tax rate, is more than 30%. And then the last one is unit trust. Because in unit trust, you are taxed, the capital gains tax is taxed in your hand. This means you invest the money, and when you withdraw the funds, all the gains, all the growth that you've earned, on that growth, you will pay tax your personal capacity depending on what your personal tax rate is. So if your tax rate is higher than 30%, a unit trust is most likely not the place for you to be. Very often people start investing in unit trust because they are in an 18 or 26% tax bracket, but then as they grow and as the income increases, etc., they go into a 31, 36, 45% tax bracket, and suddenly that unit trust is not as tax efficient again. This is the basic investments that you'll get through an investment house. Then there are a lot more tax implications when you start looking at alternative investments, arbitrage, buying shares, investing in companies, investing internationally. But for the basics, this is what you need to know. Once you know this, you've got a really good idea of what you should do with regards to your investments from a tax perspective. And when you are a more sophisticated investor that can make use of these other investments, international investments, arbitrage and such, then I think you need to speak to a financial advisor, because then your portfolio has grown to such an extent that you really need expert advice. I trust that helps. All the best. Give all. Bye-bye.